Welcome to this explainer on the AI investment memo. Today, we're putting Credit Acceptance Corporation, or CACC, under the microscope. Now, if you follow the auto finance sector at all, you already know CACC isn't just another run-of-the-mill deep subprime lender. Historically, man, it has been an absolute compounding machine. We're talking about a company with an elite reputation for wading into the absolute ugliest, toughest corners of consumer credit and somehow consistently spinning out serious, disciplined profits. It's like they had a magic touch. But, well, lately, when you start peeling back the layers and really looking closely at the data, this legendary machine, it might suddenly be showing some real cracks.
Okay, let's dive into this because the central question for our analysis today is incredibly straightforward. Is this legendary compounder still a buy? We're applying a highly skeptical buy-side framework to this one. It's not just about whether CACC is competent or even if they're currently profitable, because, spoiler alert, they are. The real question is whether the business itself and the brand new leadership team running it deserve exceptional long-term trust with your fresh capital today. Under that strict standard, we basically have to start at a default no and force the data to prove us otherwise.
Section 1. A history of discipline, forged in crisis. Let's get into it. To really grasp CACC's current competitive moat, we've got to look in the rearview mirror for just a second. Their modern reputation, it wasn't born from some magical algorithm. It was literally forged in crisis. Let's just fly through this history real quick. So the company was founded way back in 1972, serving a super niche credit-impaired market. But things got incredibly rocky after they went public. In 1997, they were growing way faster than they could properly forecast, and they practically drove the company right off a cliff. I mean, we're talking massive financial charges, a total system reset. But here's the thing, that near-death experience? It was the ultimate turning point. It forced them to build this ironclad culture of financial discipline. They launched a new digital origination system called CAPS in 2001, tied their growth strictly to a return on capital hurdle, and just rode that discipline for decades. But look at the end of that timeline. 2025 and 2026 mark a massive transition, with virtually the entire legacy leadership team stepping down.
Which brings us to Section 2, the operating reality. Cracks in the moat.
Look, we have immense respect for that historical record, absolutely. But as an investor today, you don't get to buy the past, right? You buy the future. And the modern operating evidence we're seeing is decidedly mixed. To understand why, let's briefly clarify how they actually operate, because it's a bit in the weeds. Basically, CACC runs on two main engines, portfolio programs and purchase programs. In the portfolio program, they advance money to a dealer and then share the economic risk and the collection upside over time. It's a partnership. In the purchase program, they pay the dealer upfront and essentially swallow more of that downside credit risk themselves. Now, this complex structure is exactly what makes their business so incredibly hard for outsiders to evaluate cleanly. It means we have to dig way past standard accounting to see what's actually happening under the hood.
Now, what's really interesting about this slide is the fascinating tug of war going on right now in their core metrics. On the bullish side, CAC just hit a record number of active dealers in 2025, reaching over 15,000. Sounds great, right? But look at the bear case sitting right next to it. Their productivity per dealer is dropping fast. Unit volume actually fell over 12% in 2025. Basically, this tells us they're working way harder just to stand perfectly still. They're adding all these new dealer relationships, but those connections are becoming materially less productive. So right now, it's feeling a lot less like a compounding flywheel and a lot more like a treadmill. And this single number right here really drives the whole thing home. 4.5%. That is CAC's estimated market share in their core segment of used subprime auto financing in the first part of 2026. Just a year earlier, that number was 5.2%. Now keep in mind, they operate in a massive overall market, so it's not like they're constrained by a lack of consumer demand. What they are constrained by is the ability to actually win that business profitably. The directional change here is what's absolutely crucial. A shrinking slice of the pie shows us a company that is slowly but surely losing ground to its competitors.
Moving on to Section 3, the margin squeeze. This is where it gets really tough.
So let's say you're willing to forgive a slight dip in market share, right? Maybe you assume they're just maintaining their ultra-strict pricing discipline and walking away from bad deals. Well, the problem with that argument is that the underlying economics of the loans they actually do make are under severe pressure. Just look at their economic spread. That's the gap between the adjusted return they make on their capital and the cost of that capital. Back in 2021, they enjoyed a massive 8.1% spread. Beautiful. But by 2025, that spread had compressed all the way down to just 2.0%. I mean, wow. Yes, they are still making money for sure, but that excess return has shrunk dramatically. A business that only barely clears its cost of capital in a highly competitive, high-risk sector, that is simply not an exceptional compounder right now.
Now, to be completely fair and give credit where it's due, they aren't facing an immediate liquidity crisis or anything. Their funding actually remains very steady. They're sitting on over $1.2 billion in unused credit lines, and they recently pulled off a $450 million asset-backed security deal at a very solid 5.2% cost. So the capital markets, they're definitely still open to them. But remember our skeptical framework from earlier? Adequate access to funding in normal times is just a basic requirement for survival. By itself, it does not make for an exceptional premium-priced business.
Section 4. Hidden Risks and Red Flags. Let's look at what else is lurking beneath the surface.
We really have to look past those shrinking margins and acknowledge the hidden costs of playing in the deep subprime space. Make no mistake, it's a rough neighborhood, and it comes with significant regulatory and transitional headwinds that management suggested numbers, well, they often just leave them out. Check this out. They currently have an $82.6 million recorded legal accrual balance as of March 2026. This stems from some serious ongoing regulatory scrutiny, including a lawsuit originally filed by the CFPB and the state of New York alleging deceptive practices. Now, just to be clear, we aren't taking any political sides here at all. We're just neutrally evaluating the financial impact of the source material. But the harsh reality is that for a lender operating in this controversial corner of consumer finance, massive legal heat isn't just one-off background noise. It's practically a recurring feature of the business model. And since management tends to exclude these contingent legal losses from their economic profit calculations, it makes the business look a fair bit cleaner than it actually is.
And then we have the ultimate wild card, the actual people running the show. We've seen a staggering amount of executive turnover lately. Brett Roberts, the CEO who basically guided much of their modern success, retired in 2021. Then, in late 2025 and early 2026, we saw a massive exodus of legacy talent. We're talking the CEO, the Chief Analytics Officer, the Chief Treasury Officer, all retiring. Out with the old, Vinayak Hedge stepped in as the brand new CEO in November 2025. Now, his new playbook heavily features AI implementation, really aggressive cost reviews, and staff layoffs. And, hey, it might work brilliantly. But it also means we absolutely cannot blindly trust the old institutional memory anymore. The old guard is gone.
Which brings us to Section 5, the final verdict.
So what does all of this mean for you, the investor? We've looked at the history, the shrinking margins, the regulatory overhang, and this massive management transition. So the crucial point is this. CACC is an impressive historical case study, no doubt about it, but it is not a high-confidence investment today. The stock has been trading around a 13.3 trailing PE multiple. Optically, on paper, that might look kind of cheap, but for us, this is a pass. A cyclical, highly regulated lender dealing with severely compressed economic spreads and a brand new leadership team simply shouldn't command a premium level of trust. Until that spread re-widens, the risk definitely outpaces the reward.
Of course, business situations evolve, right? Nothing is set in stone. For our verdict to flip from a pass to a buy, we need to see some very specific directional shifts. First off, we need to see stabilizing market share without them sacrificing that legendary underwriting discipline. Second, we need a full legal resolution that doesn't force them into making operating concessions that'll end up hurting future profits. And third, we need proven multi-quarter execution from CEO Vinayak Hedge and his new team. Basically, we need cold, hard proof that their new AI-driven strategy actually widens that economic moat rather than just trimming the fat and cutting costs.
Until we see that concrete proof, you really have to ask yourself a very tough question as we wrap this up. Are you willing to pay a premium for a moat built by ghosts? The people who engineered CAC's legendary historical returns have largely left the building. This new team, they have to earn your trust and your capital all over again. Thank you so much for joining this explainer. Keep your standards high out there, and we'll see you next time.